Kohl's is once again under activist investor fire from the very same person who settled a fight with the company last year. Macellum's Jonathan Duskin is looking for more board seats after sending a new letter to the company today threatening a proxy fight. Mr. Duskin with me here exclusively at Post 9. Welcome. It's good to see you. You're like the gift that keeps on giving for somebody who follows activist investors. But I got to tell you, I mean, for Kohl's, you're probably like a gnat at this point. Like, why are you back again? This is like, what, the third time?
This would be the third time, and thanks again for having me on. I'm glad I'm providing a lot of entertainment and hours of coverage for you. Look, this is a company that we think has tremendous value. This was once a darling of the retail space. We think this is a company that, with the right board configuration, with the right resources on the board, the right oversight, this can be, darling of retail once again. There's tremendous turnaround opportunity at this company, and despite running two campaigns now, business has just gotten worse, and the performance has gotten worse. The stock underperformance has gotten worse. If you rewind the tape to the first campaign we ran and identified all the things that we pointed out then, there's still the problems now, and they've gotten worse, and they've gone unaddressed. And I think with board change, there's a couple directors that we think are real obstacles. With real board change, we think this could be a great company.
You don't think the 3 board seats that you got already is quote unquote real board change?
Well, we got two of our directors, and we think they are incredible directors. Tom Kingsbury, is somebody that I think was very valuable. But it's hard to be 2 directors out of 11 or 12 that are on the board right now, and I think they were sidelined, and I think if they were really having an impact, the business would look a lot different than it does today. So I don't think there's been enough change. There's a lot of cautionary tales of incremental change that doesn't go far enough to really change the tide, and I think there's a lot of obstacles of the long-tenured directors that they're not providing effective oversight.
Kohl's today is calling your efforts, quote, unproductive and a distraction, and they point to the fact that the current board was just reelected some 5 months ago, not very long ago. And I guess I would add in a question to you, do you think it's fair to go after a retailer in the current environment, given what is going on for all retailers with inflation and the slowdown and questions about the consumer and on and on and on?
Yeah, I appreciate the question. There's a couple elements of that to address. First, everything to us is always about relative performance, right? It's not the fact that they're struggling in a hard economy. It's the fact that they're underperforming their direct peers, the peers that they themselves chose, Macy's, Nordstrom's, Dillard's. They're losing market share, right? So Macy's, the peer group sales are up, their sales are down. Their earnings are down 50% compared to 2019. None of those other companies have earnings negative to 2019. They're all up versus 2019. Inventory problems, the credit was downgraded to junk. So they have some real fundamental problems that transcend what's going on in the economy. Yes, it hasn't been a great first half for retail, but nobody's had the negative declines and the destruction of value that Kohl's has had. And I do want to address some of the other things they said. I don't think there's ever been an activist campaign where they didn't claim it was a distraction, right? I think that's true of almost any campaign I've ever witnessed and been a part of. And I just point out, we tried to work privately with them for a long time. We spent most of 2021 silent after we settled in 2021. After the AGM this year, we really haven't said anything. We contacted them in August to try to reach a constructive settlement. That was before very bad Q2 results and before the debt downgrade. And they're just unwilling to acknowledge they need help on the board. And we're not a distraction. We're not making customers not go into the stores. We're not driving the inventory up 48%, SG&A up 10%. We're not doing those things. So it's commonplace to say it's a distraction, but I don't really believe that's what's hurting.
You wish you would have